Two companies, same promoter, same board, one pricing decision, and suddenly millions in tax exposure and years of litigation. That is the reality of related party transactions today. Tax authorities are no longer asking whether a transaction occurred. They are asking whether it was commercially justified, fairly priced, and backed by genuine economic substance. I am Sadaf Zariwala, and I welcome you all to this podcast on related party transactions through income tax lens of Affluence Advisory. Affluence Advisory is a leading consulting firm based out of Mumbai, which is ISO certified, wherein we help businesses navigate complex financial and regulatory landscapes by helping them navigate through governance, tax, transaction advisory related issues with strategic insights. And speaking of strategic insights, today we have with us a special guest, CA Sakshi Ladia, a qualified chartered accountant who works extensively on related party transactions through due diligence and mergers and acquisition assignments. She believes that these transactions require key attention to detail, as even small oversights can lead to substantial financial exposure and hefty penalties. Sakshi, a very warm welcome.
Thank you, Sadaf, for such a warm welcome. And I'm really thankful to Affluence Advisory for giving this opportunity on speaking my views about related party transactions through the income tax lens.
So, Sakshi, let's begin at the foundation. What is a related party under the Indian income tax law?
So, related party under income tax, or for that matter, any law, means any party who can influence your business decisions. That could be directly through your shareholders, through directors, or through your board. There are few legal triggers that is, if you hold 26% or more voting rights of another company, you are guaranteeing 10% or more loans of another entity, you have the power to appoint more than half the board members of that entity, or you actually have an ultimate ownership of that entity. So related party, if I talk about, is not only dependent on the shareholding, but it's actually intended towards identifying the control that one entity has over the another. Like we observed in Vodafone India Services case, which was at Bombay High Court in 2014. The court looked past the commercial substance of the transaction and paid attention towards the control that the parent and the subsidiary entities were having over one another. And that is where we identify what are related parties.
So, we will say that it's less about the paperwork structure and more about who actually has the influence in practice. So, building on that, Sakshi, once the relationship is established, what kind of transactions typically come under this tax scanner?
So any transaction which amounts to income flow and shifting of profit amounts to related party transactions. So it could be sale of products, sale of services, giving loans, intercompany loans amongst group entities, guaranteeing, that is giving corporate guarantees of loans amongst group entities. So all of these transactions which actually depict shifting of profits come under related party transactions. If we talk about thresholds, for international transactions, we don't have any threshold as such. Even a small amount could trigger transfer pricing regulations. But in case of specified domestic transactions, we have the limit as 20 crore for transactions. But said so, the tax authorities have been given power to identify whether a transaction is excessive in nature through section 48(2), which we'll be covering in the following podcast.
All right. So even a single transaction can trigger the entire transfer pricing and the related party transaction framework.
Right.
So building more on that, can you take us through, like, once a transaction happens, what follows? Like, what are the rules, sections, provisions that gets triggered due to an RPT?
So you have to we'll be actually covering it into three layers. The first is identifying whether a transaction is at the fair market value or not, which is governed by section 48(2) of the Income Tax Act, which sees whether a transaction has taken place at fair market value or below that. And that is when it triggers related party regulations. The next layer pertains to international transactions, International transactions are governed by arm's length pricing. So international, it is very important that if two related entities, one of them might be in international jurisdiction and one of them would be domestic, the transaction happening between them should be on arm's length basis, and if not, then that attracts related party transactions. And third and most overlooked layer is of specified domestic transactions, which take place between two domestic companies of Indian jurisdiction, but because the transaction is not happening at the arm's length price, the arm's length pricing and transfer pricing regulations become applicable.
Understood. So, we understood a fair idea about what the related party is, what kind of transactions cover. So, Sakshi, here's one question for you that catches many finance teams off guard. Can a domestic transaction between two Indian companies be deemed as an international transaction?
Yes, so we have a very particular section, that is 92B2, which governs this type of arrangement. So I'll just explain this with an example.
Sure.
Suppose there are two entities, entity A, entity B. Entity A is purchasing goods or services from entity B. Now these two are completely unrelated parties. They don't have any kind of relationship. So they would, in normal parlance, they would not be treated as related parties. But twisting the scenario, if suppose the pricing at which entity B gives the products to entity A, that pricing is determined by some international entity. So here the transaction is indirectly controlled by an international entity, and hence this transaction is deemed to be an international transaction under section 92B2.
Well, that's a very significant exposure. How do finance teams identify and deal with these risks?
So it's very simple. You just have to ask one simple question to the transaction or to the the entities, that whether this transaction is independent or is being controlled by any international party. If the answer is yes, then obviously it is deemed to be an international transaction.
Understood. So the law and the provisions are really made to prevent the overpayment rather than banning all the related party transactions altogether. So, how do tax authorities determine whether something is excessive in assessments?
So there are quite a few sections which help the tax authorities determine excessiveness in the transaction. The first one is 40A2, which helps tax authorities identify whether the transaction is happening at a fair market value or not. If a transaction is happening at a value which is lower than the fair market value, the difference is getting taxed. Then there are few sections which deal with cash transactions, which often don't come under the lens because of obviously the cash element in them. So there are few provisions in the act which prohibit some transactions between related parties, or for that matter any kind of entities. So first is section 269 SS. 269 SS tells that you cannot accept loans, deposits or property advances from any person in excess of 20,000 rupees other than banking channels. The penalty here is straight, that the penalty would be 100% of the transaction amount under section 271D. Similarly, there is a provision which is 269 ST. This provision says that you cannot accept cash payment from a single person in excess of 2 lakh rupees in a single day for a single transaction through cash, that is other than banking channels. Here again the penalty amount is hefty, which is 100% of the transaction amount under section 271DA. And lastly, there is section 269T, which is mirror section of 269S, which talks about repayment of the loans in excess of 20,000 through channels other than banking. Here, similarly, the penalty amount would be 100% of the transaction amount. So, as you see, the penalty which gets imposed whenever these sections are invoked is a hefty penalty. That is not a percentage of penalty, but 100% of the transaction value could be harmed as penalty to the taxpayer. So that is why these transactions need careful observation while dealing with any kind of cash transactions or related party transactions.
All right. But if there's any non-cash movement within the intergroup companies, so how is that accounted for in the books?
So since there is a cash element involved, obviously there would not be any way to give evidence about the same. There could always be a suspiciousness about the transaction. So there have been many ITAT rulings wherein it has been said that if there are journal entries in the books of group companies, it might amount to cash transactions be getting suppressed. So it is through the journal entries that the auditor or the income tax authorities might ask you questions about the evidence or the substantiality of the documents for the particular transactions.
Understood. So going further, Sakshi, there are many Indian companies which are funded by their parent company, parent foreign company, through the way of loan and not equity. So what is the underlying risk which forms here?
Yes, so there is section 94B, which is thin capitalization, introduced in 2017. So what this section says, that a foreign parent company can fund its Indian subsidiary in form of debt other than equity. The Indian entity would be paying interest and claiming deduction of the same in its P&L. So 94B puts a cap on that. What it says is if you are paying your foreign parent company interest, it cannot be more than 30% of your EBITDA. That is to say, any amount beyond 30% would be disallowed.
So what if this disallowed interest is too large?
So, given that the transaction could actually be genuine transactions, the authorities have given a relaxation to the taxpayers, saying that if the amount is huge and you need to defer it, since you are not getting greater than 30% of your EBITDA, it is getting disallowed. You are allowed to carry it forward for 8 years, but you have to be careful that in the further years you still have to check whether your interest that you're claiming for the interest on your foreign company loan, it cannot be 30% of the EBITDA for that particular year. There's also one exception to this case. If the interest that you're paying to your associated enterprise is not more than 1 crore, these sections do not apply.
All right, understood. That's a concise explanation, I would say. So, going further, now let's discuss a core concept which underpins everything that we have discussed up till now, the arm's length principle. Can you briefly explain what is it?
So, arm's length pricing and arm's length principle, for a layman to understand, I would explain it with using an example. So, suppose there is an entity who's paying its foreign entity a royalty of 15%. Now, if you actually go into the depth of the transaction, you as a tax authority identify that that transaction is actually worth of 3% royalty, but you are giving 15%, or that is you are giving an additional 20% of the 12% of the royalty. So here the income for Indian authorities, Indian tax authorities get vanished, because you are claiming 12% additional expense of the royalty income. So this does not amount to arm's length pricing. The arm's length price here would be 3%.
Got it. So that's a very intuitive way to frame it. So how do practitioners actually determine what is the arm's length pricing? What are the methods for it?
So yeah, calculation of arm's length pricing could be actually overwhelming because of multiple methods. I'll quickly just brush up through all the methods which are there to calculate the arm's length pricing. The first is comparable uncontrolled price, that is the cup method. This is mostly used when we have commodities. So what we do here is we identify similar commodities and compare the prices of the two. The price of the commodity in transaction and a similar commodities price. And hence we decide the comparable price and identify whether the transaction is happening at an arm's length price or not. Next is a resale price method, which works backward from the selling price. This actually is used by distribution companies. The third method is cost plus method, wherein you see how much markup has been done on the cost. This is actually this is basically for those companies who do contract manufacturing. The fourth and the most commonly used method is transactional net margin method, which is the easiest way to identify whether a transaction is happening at arm's length or not. So here you compare the net profits between your company and a similar company. If the net profits seem to be comparable and similar lines, it will not amount to any transfer pricing or related party transaction. It will be at arm's length. This is used by 70 to 80% Indian cases. And the last method is profit split method, wherein you use this method when there are two entities who are contributing to a transaction or to a product or to the efforts in an equal proportion. So this is basically when you are joint manufacturing some things. So there are few methods and some cases where these kind of methods could be used to determine what is the arm's length price.
So it does really converge towards the transactional net margin method, we could say.
Correct. Yes, definitely.
So far, we have covered the pricing rules, cash rules, thin cap, and the secondary adjustments. Is there any overarching provision that sits above all of this?
So what does GAAR provisions tell us is that if any transaction does not, according to the general provisions of the law, does not seem to be a related party transaction and does not attract any kind of transfer pricing rules or arm's length principles, but according to GAAR provisions, it appears to be a transaction which lacks commercial substance and is actually done to shift profits and evade tax, then GAAR would be invoked and that transaction would then be seen and from the GAAR lens as related party transactions.
All right. So, how is generally accepted anti-avoidance rule different from the normal transfer pricing rules?
So GAAR sits on all of these rules. So GAAR has its own sets of rules, own sets of principle to identify whether a transaction is lacking commercial substance or not. So if the other rules of transfer pricing and other provisions of the law are compulsory, but GAAR has a different perspective from all of that and it overrides all of these sections.
Understood. All right. So, Sakshi, that was the part one of this podcast of decoding related party transactions through the income tax lens. We have so far covered a basic idea, a little more about transfer pricing, RPT, and the international transactions as well. So, in the next part, we will be covering the recommendations and the evolving landscape of this world. So, do follow our LinkedIn page and subscribe to our YouTube channel for the next part and for more such updates. Thank you.